Hello friends, true and fair view as per IFRS. Let's discuss about that in today's video. Hi, my name is Pratij and welcome to Deep Dive into IFRS. If you see, there is no proper definition of true and fair view in IAS 1, but the conceptual framework to IFRS gives the definition. A financial statement is supposed to give a true and fair view if there is a faithful representation of the effects of the transactions, other events and conditions as per the definition and recognition criteria of assets, liabilities, income and expense as per the conceptual framework. So this is the definition given in the conceptual framework to IFRS. You have to compare this with the relevant IFRS dealing with the particular item in question. Now let's analyze this with a few examples to make it clearer for you guys. As per the conceptual framework, an asset is a resource controlled by the entity and it expects future economic benefits to flow from it. But if you adhere to this definition in the strictest sense, it wouldn't always give you a true and fair view. You always have to analyze this in connection with the relevant IFRS dealing with a particular item. Let's analyze this with a few examples to make it clearer for you. Suppose you're constructing a factory in a rural area costing about 100 crores. But as there is no road access to it, you construct a road as well costing about 1 crore rupees. Now in this example, the factory is a resource controlled by the entity and the entity expects to gain future economic benefits from it. So as per the conceptual framework definition, this can be recognized as an asset. But when it comes to the road, the entity does not have a control over the road. Anyone crossing the factory or any public can access the road, they can use it as well. And the entity can't sell the road either. So as per the conceptual framework definition, this does not qualify to be an asset. But as it's costing 1 crore, you can't ignore this as well. So in this case, the road is required to bring the factory to its present condition and location. So if you tie this with IAS 16 dealing with property, plant and equipment, as per the definition given in IAS 16, this road qualifies to be an asset. So if the financials are to give a true and fair view, both the road and the factory have to be taken as assets in the financial statements. Now let's look at a few liabilities. As per the conceptual framework, if an item is resulting in an obligation to pay, it qualifies to be a liability. So let's look at equity, dividend, redeemable share capital and preference share capital. When it comes to equity and dividend, the entity has no obligation to pay. It's its discretion. So as there is a discretion to pay, both these don't qualify as liability. They form part of the equity. When it comes to redeemable share capital, the company has an obligation to pay and hence that qualifies as a liability. When it comes to preference share capital, there can be two types of preference share capital. If it's a normal preference share capital, earlier the entity is not eligible to be brought under IFRS. Generally, we take the normal preference share capital also under capital and reserves. But in IFRS, if it's a normal preference share capital, there is an obligation to pay and hence this should be a liability only and not part of equity. But if as per an agreement, the entity has a discretion to pay, then this qualifies as equity. Over and above all this, the management has to give an explicit and unreserved statement of compliance that the entity has complied with all the requirements in IFRS. Only then does the financial statements give a true and fair view. But in an extremely rare circumstance, if the management concludes that adhering to a particular provision in an IFRS would be so misleading that it would conflict with the objectives of the financial statements, then IFRS allows for a departure. But when you depart from a particular IFRS, you have to disclose the following items. Number one, management's conclusion that the financial statements give a true and fair view. Number two, a statement of compliance that the entity has complied with all the IFRS except the one it has departed from. Number three, title of the IFRS departed from. Number four, nature of departure. Number five, the treatment prescribed by IFRS and the treatment the entity has chosen. Number six, financial effect of the departure. And finally, number seven, why the entity feels that following IFRS would be misleading. Now, there can be another interesting situation where, as the management, as an entity, you feel that you have to depart from IFRS to give a true and fair view to the financial statements, but the relevant regulatory authority prohibits that. So, what to do in such a case? There is no other option but to go with the relevant regulatory framework. IAS 1 accepts that. In such a case, you have to disclose the following: the title of the IFRS in question, the nature of the requirement in that IFRS that is in question, why the management feels that complying with this specific requirement would be so misleading that the financial statements would give a wrong impression and it would be in conflict with the true and fair view, and finally the adjustments that the management believes have to be made to certain items to bring out a true and fair view. So this last situation is highly theoretical and it's very highly unlikely that such a situation would arise where a departure from IFRS would be required to give a true and fair view. I hope this video was useful to you guys. Till I see you in my next video, thank you for your valuable time.